Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about 6 different stocks that you should start buying or at least looking into. Today is Friday, September 16th. The market is not doing very well, let's just say that. We're going to start off with Microsoft. Microsoft has had a troubled year, as you can see, from 300 now at under 250. The high being 350, so down $100 from the high with 250 left to go, and that margin is around 30%. So 30% exactly, and Microsoft is down from the high. Of course, they do pay small dividends, 62 cents a share, and you can see that's looking to grow this upcoming quarter. Last quarter it was 50. Last year it was 56 cents. This year 62. Once this earnings comes up, we will see the new dividend might be 68 cents. It's not a dividend stock. I mean it is, but you don't buy it for the dividend. You buy it for the growth, and the growth is pretty intense, as you can see over the last, let's say, 5 years. We'll have to zoom out. You can see no real negative earnings report besides the latest one, and it's not negative. Mind you, it's just they lost to expectations. That's what I call a bad earnings report. And that is what happened here in the latest quarter ending, you can see period ending June 2022, where they fell barely short, and the new earnings is coming up in October on the 26th. So look out for that. But what I recommend you do with these stocks is maybe, load up, buy a couple of shares right now, because what we have to find is a substantial support, right? And that's, I would say, right around 200. Oh, wrong one. I'd say the hard stop support for Microsoft is around 200 to 190, right? So we're at 244 right now. It could fall another $44 theoretically, and then it would be the best buy ever. Right now, it's a really good buy. So what you could do is buy a couple shares and just wait. Watch it and wait, because it could recover fully, right? Go back to 300, then 350. Or it could go and fall even more, and you just keep adding in, lower your cost basis while you get more shares. That's what I hope you guys do with each of these companies today. So first off, Microsoft, good play. Second is Google, and you can see the price here is also cut, and we're at the lowest so far since April 2021. But we're looking at the high compared to the price now, 150 to 102, down 33%. So basically 150 to 100. Theoretically, Google could fall down to the 70s, right? That's another 25% from now. And that is when it would be an amazing buy. But right now, it's a really good buy. So what I recommend you do is buy a couple of shares and wait, right? It could go up next week to back to 120, or it could keep falling down to the 80s and 70s, where you should quote unquote bet the house, take out a mortgage, whatever. No, you shouldn't really do that, but I'm just saying by then it will be a very good investment, very good risk to reward. Right now it's still really good, right? We could fall to 80, that's a $20 risk, and we could go back up to 150, that's a $50 reward. So 20 to 50, 2 to 5, or 1 to 2.5, basically. That's our risk to reward right now. Anyways, guys, Google is second on this list because of the market cap, and you can see the last 2 earnings reports have been bad compared to the expectations, and that is not good, and they do not pay a dividend. Next on our list is a very beaten down company, Meta, Facebook. You can see the high on this one is $380, and the low right now, which was today, is 144, down 62%. This company, so basically 2/3 of the value was cut. It is down now to its depths of COVID levels, right, where no one wanted to touch it. It's also down back during the scandal, right, with the analytics company. That low was 130s, 140s. The very depths of COVID was 140. Right now we're at 144. So if any play in this selection is contrarian, it's going to be this one and the next one, because these two companies have just been hurt beyond recognition, right? Nobody's really talking about Facebook right now. They're talking about other companies, right? They're kind of ignoring Facebook. It's down too much risk. But once you realize that the more it has fallen, the less risk you're taking on, then you start to like these companies. You start to buy these companies because they're being down so much. They can't fall hardly any further. But guys, yeah, Microsoft, a terrible, terrible investment in the last year, which makes it a better investment this year, right? You can see that RSI is very low, under 40. It's definitely had some tough times lately. So we could see upcoming earnings report will be November 2nd, and then we will see where Facebook goes from now. But it does not pay dividend. It's had a tough time lately with TikTok being their main competition. So it's all about user retention. If TikTok is, overachieving, then Instagram Reels, Facebook Clips, or whatever has a hard time retaining that customer information and selling them ads. So let's see where Facebook ends up soon. Right now, it's a beaten down company. You can buy a couple of shares and wait. That'd just be good to get some exposure to this company in the meantime. Next is the other stock that's been beaten down beyond recognition is Nvidia. I've been looking into Nvidia quite some time just because it's similar to Facebook, 340, now down to 128, down 63% when Facebook was down 62% from the high. And you can see this company actually has a very positive record of earnings reports, but we've talked about this one before, right? You can see, all right, I'll talk about it again. So this is date, period ending July 2022, right? We go 1, 2, 3, 4, back to this July 2021. Earnings were $1.04 a share. Now this earnings report was 51 cents a share. If you remember, Nvidia cut their price target by a large margin for the upcoming earnings report, somewhere in this range, and that cut the stock and cut the expectation. So it was $1, and they cut it to 50 cents because they're only expected to make 50 cents this quarter. Well, it turned out to be true, and even though they beat that by a penny, the stock didn't do too bad. You can see right here. They didn't do too bad. Nothing really happened until after the fact. So we will see where Nvidia ends up. It's also one of those diminished contrarian plays back to COVID levels. Actually, no, that's not true. COVID levels is down to the 50s. So we have a lot more to fall with this one. But just based on the growth recently, it should not be down this much. That's just my opinion. Next is Nike. And this stock has, it's not a real big play, a major play here, but it is down 80 bucks from the high. You can see now we're trading at $100 instead of 180, where Google was down from 150 to 100. Nike's down from 180 to 100, down 42% or so. And it does pay a dividend, although slightly, 30 cents a share. And earnings report is soon, 93 cents a share they're estimating. Last quarter was 90, and we can see this quarter last year was in fact $1.16, and now this one's 93 cents. So it's not looking to be very good for Nike, especially just because it's a company that has nothing to do with tech like Microsoft, Google, Meta. It's a apparel company, right? They make clothes, they make shoes, they make certain accessories for your outfit, and that's what they do. That's hardly has to do with tech. So Nike at $100, the very COVID low was 62, so it does have some room to fall. Although I do think this is a solid stock with some solid growth prospects. I do not see it falling much lower, but I'd be happy if it would. I'd like to load up on this one. That's Nike. Small dividend earnings are soon. I'm excited to see where they say that they are and where they see they are going next quarter. Lastly, in this video is Triple M, 3M. You can see it's down right down to COVID levels, and that is a good I would say a good guess as a very good price for this company. You can see during COVID, it hit 115, then it hit 207. So it went from 115 to 207 up, $90 or so. And now it's down to 115 again, 114. You can see earnings reports since has been pretty positive. This quarter, we are estimating to make $2.67 a share. When this quarter last year, we made $2.45. So earnings are still growing for 3M. That's a good sign. And that dividend is still a nice, juicy $1.49 a quarter, making it $6 a year. On a $115 stock, you're getting 4%. Best of these few selections here, although this is the most, I'd say, the oldest company, and I would say, what's the word I'm looking for? It's not growing. It's not a growth stock. It's a value stock. That's what you're buying. You're buying stability, dividends, and long-term growth. Microsoft, Google, Meta, Nvidia, Nike, they're growth stocks because they're growing more than they are paying out as a dividend, or looking ways to scale back. No, 3M is exactly that, stability. At least that's what they promise, right? You can see they're down $258. That was in January 2018, has yet to fully recover. While I do think this is a low price, I don't think it will stay here for very long. As with all of these stocks here, lastly, I'll go over the list again: Microsoft, Google, Meta, Nvidia, Nike, and 3M. Let me know what you think of these picks. I have very good hopes on these, and I'd like to hear what you have to say. Thanks for watching.